Good morning. Thank you for joining us. We're just going to give it a few moments to let others log in before we get started. Okay. Hello, everyone. I am Jan Vega, a wealth manager in our Los Angeles office, and I'm joined by my colleague Laura Boucher from our Milwaukee office, John Allen, our Chief Investment Officer, and Marc Castellani, Managing Director of our Investment Strategy and Research team. So we are headed into the end of 2025, and we're still seeing the economy is still growing, though things have slowed a bit. Job growth and spending have cooled, but overall the market's been resilient. AI continues to drive market performance, supporting the earnings growth, fueling investment in data centers, and shaping where the growth and inflation might go next. At the same time, we're watching a few other areas that might put pressure on the market, such as the possibility of a longer than expected government shutdown, a softer US dollar, and the fact that most gains are still coming from just a few large tech companies. So our goal today is to look beyond the headlines, to talk about what really matters for investors, where opportunities still exist, and how to stay balanced and confident through this next stage of the cycle. To make the most of our time together today, please feel free to share what's top of your mind by submitting questions. You can use the dialog box on your screen at any point at time during the conversation, and the presentation slides are also available on your screen. Before we get started, we wanted to briefly also share that we'll be soon changing the format of our client webinars. With such a diverse client base, we've gathered feedback on how we can continue to improve. And our goal is to make these webinars as effective and relevant as possible for everyone. And while we're not going to be discussing the specific changes just yet, starting in April of next year, you'll notice some updates to the format, content, and our overall approach. We're working behind the scenes on these improvements and excited to roll them out soon. So with that, I will hand it over to John.
Thanks, Jan. I think what you meant to say is that in the future, Marc and I will appear less stiff and a little less boring, and that is what we're going for. These should be webinars that enable our clients and our advisors to get as much out of them as possible. So we're working towards that format, and we're excited for April and the release of our new formatting. So let's go ahead and get into it. So clearly there are a number of powerful forces shaping the world order today. We've grouped them here into 5 different categories: economic growth, technological advances, resource availability, energy availability, and political tensions. And importantly, any one of these can occur within a country or across countries. And we're going to touch on each of these forces throughout the conversation today. So today, some of the most important aspects of economic growth are the global flow of goods and services. And that includes tariffs and other restrictions, as well as income and wealth generation and distribution or redistribution, as the case may be. These are critical forces because they determine whether our standards of living are improving or worsening. The second category of forces relate to technological advances. And today that means artificial intelligence, robotics, autonomous systems, AI-enabled national defense, cybersecurity, as well as cyber warfare. And each of these has the ability to change the playing field by expanding the set of opportunities, but also the set of threats. Marc's going to highlight some of our latest AI research in just a few moments. Then we have resource availability. And here we've called out some natural resources, including the 17 rare earth elements, or simply rare earths, as well as critical minerals such as lithium, phosphate, and titanium. Next, energy availability is vital to any country's competitiveness, especially given the critical role of energy demands of AI, and Marc again is going to touch on that in a few moments. And there are political tensions both within and across countries. For example, different ideological foundations for democracy, whether capitalism or socialism, as well as communism, authoritarian systems, as well as theocracy systems. We can cite many examples of internal political tension in the United States. A few are political protests, government shutdowns, and political redistricting. Abroad, on Sunday, Bolivia elected its first pro-government president, Rodrigo Paz, who campaigned on the country establishing closer ties with the United States and also developing its global leading lithium reserves. Perhaps the current state of affairs can be likened to a second Cold War, And to be clear, we don't think that that means a military conflict, and we don't think that bullets have to fly. Rather, it means rapidly building up one's capabilities, particularly in an effort to avoid military conflict, but also to position yourself as a higher standing within the world order. And both the US and China today, much like the US and Russia in the 1980s, along with each of their respective allies, are rapidly strengthening and flexing their capabilities in each of those 5 areas at the top of the page. We understand that this shifting world order can feel unsettling, but the US still remains the strongest country overall. And in fact, it remains number 1 based on an index of 8 key measures of power that Ray Dalio, formerly with Bridgewater, put together over the course of his career and updated most recently in 2022. And we discussed that in our last webinar, so we won't do that today. To us, the key challenge for the US maintaining its position really depends on our willingness to come together as a country and compete against other countries in order to position our country as number 1. Or we can just keep fighting each other and tearing each other down, and that may lead to not being number 1 in the future. So it's just something that we're keeping an eye on, and we hope that the country can come together. Okay, so turning ahead to slide 5, over the past 2 webinars, we've spent quite a bit of time on economic growth. So slide 5 only briefly touches on a few areas we've been monitoring closely. That's employment, wages, and consumer spending. Overall, so in aggregate, growth for each of those has been low, but steady, while weakening for lower cohorts. And we haven't broken that out today, but I'm going to touch on it in just a moment. The top chart indicates that the jobs market has cooled, and so too have wage increases. And you can see that with the black dashed arrow pointing down. So the blue line represents the unemployment rate, and it's ticked up to 4.3%. But as you follow the blue line across, it's amongst the lowest unemployment rates historically. And wage growth has cooled and now at 2.7%, relative to where it's been. Not a bad annual wage increase, but lower than it's been in the past 5 or so years since COVID. Other data points that we've been monitoring to confirm this notion of a cooling job market as well as wage market is worker productivity is steady. We're not seeing much in terms of a discernible impact from AI yet. And I'm really talking about that over the past 3 to 5 years here, where Marc is going to talk about more recently, we have started to see for lower cohorts an uptick in unemployment for lower levels of education and so on. We're seeing that as well, lower wage earners. The jobs that are most vulnerable to the advances of AI is where we're starting to see some shifting occur. Again, we didn't break that up today. Wages, we're thrilled to see, have closed the gap on necessities inflation. You'll recall we've reported on that in the past. After COVID, necessities inflation, which includes food, transportation, and shelter, really took off, and wages were lagging quite considerably. Just recently, that gap has been narrowed, if not totally dissipated. So wages have now caught up to necessity inflation. We currently have 1 job available for every 1 job being sought. And that's pretty comparable to the pre-COVID period. During COVID, you'll recall we had 2 jobs available for every 1 job being sought, but that was really an anomaly. Today, our labor force stands at 171 people, which, as we decompose that, is a similar mix of employed and unemployed people and part-time workers, and that's both for voluntary and involuntary reasons. When we compare the current makeup of those categories to non-recessionary periods since 1968. Okay, so since the labor market is low but stable, we're not surprised to see consumer spending on the lower end of normal as well, and we've shown that on the bottom chart here. The lines on the chart represent the change in consumer spending in any given year, starting at 0% going into a year for comparability reasons. And we've captured 25 years from 2000 to 2025. The peach line represents 2008. The orange line represents 2009. since we were in the throes of the global financial crisis starting in the fourth quarter of 2007, which captured both of these years in their entirety. We're not surprised that those came out where they were. And the blue line represents 2025, and that's why it's a partial line since we're still going through the year. To us, it appears that 2025 is on the lower end of normal as we look at that data. But if you go a level deeper, 2025 GDP is expected to be $29.2 trillion. Of that, consumer spending is expected to be $20.8 trillion. In other words, 71% of our overall country's GDP. Now we go a layer deeper. The top 20% of us from an income earning perspective represent about 70% or 15 trillion of that 20.8 trillion in spending. And if you note, 15 trillion is half of our country's GDP. The bottom 80% of income earners amongst us represent less than 30% of our spending, or just $6 trillion. So let me just take a moment to reframe or rephrase that. 1 out of 5 of us represents $15 trillion, or half of our country's GDP. 4 out of 5 of us represent $6 trillion of our GDP, or just 20%. And over time, that gap has widened between the cohorts. The top 20 versus the 80 has widened. And that's making the US more reliant on fewer and fewer people. And it's sowing discord between and among cohorts. So it shouldn't be a surprise to anyone that we've been facing political divides across the country. Okay, with that, let me turn it back over to Marc to talk about our research with technological advances, and specifically those related to AI.
Thanks, John. So let's get into AI, and we'll start with the Mag 7. The Mag 7 are the 7 largest technology-oriented companies in the S&P 500. So that's Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla. Over the last decade, these companies have come to dominate the market across a range of metrics. The top chart on slide 6 traces the Mag 7 share of market cap in the orange and earnings in peach of the S&P 500 over the past 10 years. Similarly, the dark blue and light blue lines indicate those same shares of market cap and earnings for the rest of the 493 stocks in the index. In 2015, the Mag 7 accounted for 9% of the earnings and 11% of the market cap of the S&P 500. Since then, those percentages have surged. Today, the Mag 7 represents 22% of the earnings and 35% of the market cap of the index. So that's 7 companies out of 500, or just 1.4% of the index by count, produce roughly a quarter of the earnings and represent about 1/3 of the market cap of the equity market. Now, market concentration of this magnitude works in favor of investors as long as the Mag 7 stocks keep ascending. To support these valuations, and specifically expectations around AI-related growth, the Mag 7, and most notably Alphabet, Amazon, Meta, and Microsoft, they've had to commit tens of billions and collectively hundreds of billions of dollars on capital expenditures to acquire leading-edge GPUs and build data centers. As a result, free cash flow, or earnings after capital expenditures, relative to price is at a secular low of 1.7%, as highlighted on the orange line in the bottom chart of slide 6. Alternatively, that free cash flow yield of 1.7% translates into a roughly 60 times multiple of free cash flow for the Mag 7. So at these valuation levels, there's not much, if any, margin for error should the pace of adoption and economics around AI fall short of expectations. So to keep the AI CapEx cycle afloat and propel AI development forward, the industry has developed a web of interdependencies. For simplicity, we will just focus on the interconnections of NVIDIA and OpenAI, the two companies at the center of the AI universe. On the illustration on slide 7, the size of the circle is commensurate with the company's value. The larger the circle, the greater the valuation. OpenAI, a private nonprofit with a for-profit subsidiary, is valued at a remarkable $500 billion. NVIDIA, on the other hand, now has a market capitalization of an extraordinary $4.5 trillion. Other companies, large and small, that orbit around NVIDIA and OpenAI fill out the rest of the AI constellation on the illustration. Orange arrows indicate that a company is providing or receiving hardware or software. Light blue arrows signify that a company is providing or receiving services. And the dark blue and green arrows denote investment or capital flows. Now for NVIDIA, you can see it has made investments in leading AI model developers, xAI, Mistral, and OpenAI, with those same companies using those proceeds to buy chips from NVIDIA. And there are similar linkages around OpenAI with technology startups and cloud hyperscalers, Microsoft and Oracle, with AI providing or receiving capital and many of its counterparties using its chat GPT models. With all these companies tethered to OpenAI, it has almost become too big to fail for the broader AI ecosystem. Nonetheless, this tangled web of relationships may accelerate AI growth in the near term, but over time, it may make the AI complex more fragile and politically exposed as these conflicts of interest become more apparent and disruptive. So one real choke point to the AI development is access to power. An AI search requires about 10 times more energy than a classic Google search. And as data centers sprout up to support expanding use of AI, the demand for power is forecast to accelerate. The top chart on slide 8 exhibits the global data center demand for power from 2015 out to 2035. In just 5 years, the expected power demand from data centers will double, and in 10 years, more than triple. In the US alone, data centers are expected to account for 10 to 12% of US electricity consumption by 2030. With interconnection queues of 5 years, lead times for power turbines stretching out years, and a regulatory apparatus inhospitable to the construction of new high-voltage transmission lines, it's unclear if we can develop the necessary infrastructure to support AI in its current configuration. AI, like most other new technologies, will not follow a linear path to mass acceptance. The hype or adoption cycle often begins with a lot of promise and early proof of concepts, drawing in media attention and capital flows. The next stage, fueled by some early success, further expands expectations and investor interest. This is followed by disappointment as outcomes fall short, interest wanes, funding recedes, and surviving companies pivot business models. From that wreckage, the next generation of products emerge, adoption grows steadily, businesses scale, and the technology eventually becomes widely established. Public market ETF expressions of the AI theme, RQ, bots, AIQ, RD, and chat, have loosely followed this pattern as shown in the bottom chart on slide 8. Overall, AI appears to be in the second phase. A lot of investor interest, in fact, about 2/3 of every venture capital dollar is going into AI or AI-related investments. So with some limited use cases, but for now, a bit more hope and promise than broad-based penetration of practical applications. With that, let me turn it back to John to discuss another bottleneck in the global supply chain for advanced technology, and that is access to rare earth minerals.
Thanks, Mark. So look, you've probably all heard more about rare earth elements or simply rare earths in the past few weeks than you have throughout the course of your lifetimes. And that's because China has been flexing its might and strengthening its negotiating position with the US and other countries. And the reality is that it's able to do so because it is the dominant global supplier of rare earths needed for magnets that are used in electric motors, wind turbines, hard drives, and defense systems. So they are vital to several key related industries, including automakers, aerospace, semiconductor, and defense, and so on. The top chart on slide 9 displays a map of the world's rare earth reserves. The darker the color on the map, the more metric tons of rare earths controlled by the country. Clearly, China is the world's largest. In fact, sources estimate that China's global supply of rare earth mining at 70%, and its processing and refining capabilities at 85 to 90% across all rare earths. And that's making the US and other developed countries heavily reliant on China for rare earths. And that said, these estimates are a bit obscured because the elements can sometimes be mined in one country and processed or refined in another. Okay, turning to the bottom chart, it reflects the response of the stocks of miners and refiners of rare earths in 3 countries outside of China. So as you can see, the stocks in the United States, Canada, and Australia were already off to a great year in 2025. But then they literally exploded when China announced it would restrict rare earths. And it's done that a few times throughout the course of the year, but most notably about 3 or 3.5 weeks ago, again, as part of its negotiations with the United States. No doubt some of the run-up reflects investors' anticipation that the US will solidify production deals with its allies, similar to friendshoring that we talked about in past webinars associated with global trade. In fact, this week, the US and Australia announced a rare earths deal with more announcements likely to come. But we also suspect that some portion of this run-up, this sort of 50 to 100% run-ups, growing to 175 to 300% run-ups, some of that, in our view, is purely speculative. Okay, although not technically a rare earth, gold has also been in the spotlight this year. The blue line in the top chart on slide 10 tracks millions of troy ounces of gold held by central banks around the world since 1980. The gold line is the price of gold per troy ounce. In August 1971, Richard Nixon announced the suspension of the US dollar's convertibility into gold. That was originally deemed a temporary suspension, but very quickly thereafter became permanent. Following that, from the 1970s to 2008, central banks reduced their gold reserves, favoring the US dollar, the euro, and other European currencies and other fiat currencies. You can see that as the millions of troy ounces of reserves was falling and gold prices were languishing during much of that period. But then came the onset of the global financial crisis. And because of the lack of confidence in any one currency, central banks started buying gold or shoring up their reserves, and the price of gold went up quite a bit. It went sideways for some period of time, but then in 2018, with the taper tantrum, along with the Fed pivot that occurred during that period of time, we had another step up of gold. And most recently, in just the past 2 years, or even less than 2 years, you get an increase of gold by about double. So from roughly $2,000 to roughly $4,000 per troy ounce. So importantly, as we look at that change, we're starting to ask ourselves, what's happening? How much are central banks responsible for this run-up? And what are some of the other forces? So turning to the bottom chart, we show the components that central bank reserves have around the world. So the US dollar in the blue is the single largest holding across the central banks, with the euro and other European currencies in the green, along with the Japanese yen in the light green. And we've also broken out here the Chinese yuan in red, but you can see it's just a sliver of the overall mix. Naturally, gold is broken out in gold bars. After losing its importance to central banks over the past 60 years or so, it was just recently began to having a new importance with central banks. And you can see that with the gold bars starting to increase in terms of the importance or the position that they have on central bank balance sheets in recent years. And as we look into the data a bit, you can see on the far right-hand side here, total reserves have grown. That's the total reserves of all balance sheets of the central banks have grown by about 117% since the global financial crisis, while gold reserves as a component within that overall growth has been 455% over the same period. Now, some countries, China and Russia most notably, have increased their quantity of gold holdings. But the majority of that increase that you see is really related to the price of gold going up, which, as I mentioned, it has doubled in about the past 2 years. So our key insight isn't that central banks necessarily are fully responsible for gold's recent run-up, but more of the central banks could become buyers, and in the future, we doubt any of them will become sellers. Okay, so turning to slide 11, we wanted to touch on another aspect of monetary policy. And here we touch on central bank policies related to supporting financial instruments in the countries, in their respective countries. The top chart here shows this aggregate size of central bank balance sheets. So first the Federal Reserve in the dark gray, followed by the European Central Bank, followed by the Bank of Japan, and then the Bank of England. We reached a peak of those balance sheets of $26.3 trillion around COVID. And since then, the central banks have been reducing their balance sheets, and we currently stand at about 18 trillion. That's the dashed, today is the dashed vertical line that you see on your screen. As we look into the future, based on what the central banks have communicated, we expect additional tapering of their balance sheets, but at an even slower pace going forward. So as we look at the support from the central banks, we don't think necessarily that the bank balance sheets will increase, but they could, depending on who Trump chooses as a Fed chair, as well as other dynamics at the FOMC. Marc's going to talk about that in a couple of moments. But more importantly, we don't think that the balance sheets will run off any faster than what's already been set in terms of expectations by the central banks. And therefore, we think that there's a support to equities. Whether or not equities are volatile in the future, we think that volatility will be more extreme in the future, but we also think that there's an opportunity for equities to at least have some support from the actions of these central banks and the things that they're doing. And just to be very clear, as these balance sheets become bigger, that's more stimulative to a financial system and an economy up to a limit. And as they become smaller, it's more restrictive. Okay, so then the bottom chart, we see a similar story for gold. So higher long-term interest rates could cause gold to retreat some because investors would prefer bonds. But again, so long as inflation continues to cool, we don't expect central banks to tighten much more than they have signaled already. And again, that's the area past the dashed vertical line. So like equities, gold could find some support for monetary policy decisions in the future. Okay, so with that, I'll turn it back over to Marc to conclude with some more implications regarding monetary policy and then share some final thoughts.
Thanks again, John. So transitioning from hard currency and gold to paper currencies and the dollar. So we'll talk about the dollar here on slide 12. And here we're looking at the performance of the dollar over the first 6 months of each year, beginning in 1986, with the gray line marking the performance of the dollar against a basket of 6 major international currencies for every year in the sample. The current year, obviously 2025, is highlighted by the orange line and shows the decline of 11% as the worst first half of a year for the dollar in 30 years. Now, many factors have contributed to this decline, including concerns over U.S. fiscal sustainability, inflation levels persistently above the Fed target, a desire to diversify away from dollar assets by international investors, and a loss of confidence in U.S. institutions. For markets, no institution is arguably more important than the Federal Reserve. And the Fed, as John mentioned, is undergoing a leadership transformation that could have significant implication on interest rates, the dollar, and financial markets in the months ahead. With the current term of Fed Chair Jerome Powell set to expire in May of next year, more attention is being placed on his likely replacements. The lower chart on slide 12 shows how the prediction markets handicap the race among the leading candidates. Kevin Hassett, the director of the National Economic Council, in the orange line, seems to have the edge over former Fed Governor Kevin Warsh in the blue and current Fed Governor Christopher Waller in the gray. Of course, the Fed chair is only one vote, a critically important one among the 12 voting members of the Federal Open Market Committee, the policymaking body of the Federal Reserve. Of the 7 board of governors, that includes the chair, President Trump has appointed 3 of them. Assuming Chairman Powell resigns from the board of governors when his term ends, as has been the custom for past chairs, President Trump would only have 4 appointees on the 12-member FOMC, potentially frustrating his desire to have much lower interest rates. Sure, there is an outside scenario that could allow for more immediate control of policymaking among the Trump appointees, should the firing of current Fed Governor Lisa Cook be upheld by the courts, but we'll leave the details and discussion of that for another time. So with that, let me close with slide 13. In short, our concluding thoughts are similar to those shared in previous webinars. A generally positive economic outlook, but not uniformly so. A clear bifurcation between upper and lower income households, and a growing list of new risks. Economic conditions in the aggregate remain relatively strong. U.S. economic growth is forecasted to come in around 2% annualized for the third quarter, down from the 3.8% pace recorded in the second quarter, but up from the negative 0.5% rate in the first 3 months of the year. Labor markets are healthy by historical measures with low overall unemployment, but youth unemployment, those 20 to 24-year-old, is at its highest level in 10 years. Hiring is also soft and narrowly concentrated in a few sectors, and labor force growth due to the clampdown on immigration is virtually zero. Fortunately, rising productivity, or output per hour worked, has climbed higher in recent months and can help offset any adverse inflation and economic growth consequences from a static labor force. Core inflation, so that's excluding food and energy, has declined from the peak of 6.6% in September of 2022 to 3.1% on a year-over-year basis. But progress has stalled for the last several months, with inflation consistently stuck around 3%, and the Fed target of 2% looking more like a floor for inflation rather than the upper bound we experienced for much of the past 30 years. Now, a person's perspective on these economic crosscurrents are largely driven by income levels. Lower income households are experiencing stagnant real wage growth and struggling to afford basic necessities. This has resulted in higher defaults on credit cards, auto loans, and student loans, and the significant use of buy now, pay later programs. Conversely, higher income households have had positive real income growth and have also more directly benefited from record asset prices. These conditions have led to more spending, especially on discretionary items like travel and upscale dining. The top 10% of households now account for almost half of total consumer spending. And layered into this economic picture, we have mounting uncertainties around the ultimate cost and return on investment from the massive funding of AI, a growing concern around U.S. fiscal sustainability, rising geopolitical tensions and conflict, changing trade policy and shifting global supply chains, and finally, central bank independence. As we said before, we think the best response to this greater uncertainty and unpredictability is to maintain a diversified portfolio. That's owning U.S. and international stocks and bonds, as well as diversifying assets such as gold and other hard assets. And where appropriate, holding an allocation to private markets. At the same time, investors need to have the agility and wherewithal to thoughtfully reallocate across the portfolio should market drawdowns occur and new opportunities emerge. So with that, let me turn it over to Jan and Laura for any questions.
Thank you, Mark. Before we start our Q&A section, I would like to remind you that if you would like to submit a question, you still can. Please use the Q&A box on your screen. We received several great questions during the presentation. Let's begin with a few questions that have made headlines in recent weeks, but weren't covered in our prepared remarks. As we know, a short government shutdown typically has none or little impact on the economy and the markets. However, if the shutdown lasts several weeks or longer, as it is currently, which areas of the economy would be affected first, if any, of course?
So, Mark, you want to get us started?
Yeah, I think that just for perspective, I think we're into day 23. The longest government shutdown, I think, was 35 days. So we'll probably eclipse that in the next couple of weeks. And I think the pressure to do something will build. I think the fight around the shutdown is around subsidies to Obamacare, the affordable care provisions, healthcare that people are buying through the exchanges. And that window opens November 1st. It extends into, I think, mid-January. So as people are going to buy insurance and they're not seeing any subsidies and people are declining, I think you'll start to see more pressure to hopefully have the parties come together and get something done. Near term, I think there's the most impacted things are around travel and tourism. The national parks won't be open and things around that. So I think that's where we've seen it. Obviously, there's federal government workers that are furloughed or not working. So parts of the economy around DC, which is a large federal employer, are probably suffering more than other parts of the country. But historically, because these things haven't persisted for very long, there haven't been long-term and persistent damage to the economy, and hopefully the result here is similar to that.
Yeah, I think Mark covered a lot, and we issued recently what we call a quick takes. Andrea Boehm, a member of our investment team, as well as Camilla Kremer, led that effort to put together a communication. You can find it on our website if you're interested in reading it, or your CST, your client service team, can get it to you. But that does cover the comments that Mark pointed out in a little more detail. I just also mentioned that one of the things that seems a bit critical at the moment, and by a bit for those that are affected, it really is quite critical, are the 42 million people around the United States that are on Supplemental Nutritional Assistance Program, otherwise known as SNAP. If the government shutdown isn't reconciled by October 27th, which is Monday, the benefits, aka the food that those 42 million people receive in the month of November, will be in jeopardy and will likely be skipped, except for the states that make up for that shortfall. So California has already announced, Governor Newsom has announced that California is likely to fund that shortfall. But it is a monster problem for many, in particular in the state of Texas, California, and Illinois. So it is a deep concern, and we're just 4 days away from, again, that becoming really at risk. And just to put that in perspective, it's not only 42 million people, but for many of the people that are recipients of SNAP, it's about 70% of their nutrition. So 70% of their nutrition could be at risk starting next month. So we'll have to figure out a way to persevere and get through the government shutdown. To me, that's the most critical issue that we're facing over the next several weeks.
Another topic that came up that wasn't addressed to us, how are you thinking about blockchain as tokenization becomes more widespread?
I smiled because Mark started drinking water right when you said blockchain. Did you notice that? Yeah, I don't look. I'll get it started, Mark, and then you can add. Mark's a little closer to this than I am, but just to get him started. So we've periodically touched about cryptocurrencies. There's a wide-ranging view about cryptocurrencies in terms of their importance. And a storehold of value and whether or not they're good in terms of diversification for a portfolio. We've often said that we lean towards owning gold inside of diversifiers for clients that are hold a dynamic portfolio with us. We have held gold through our diversifiers since about 2019. That's been more important for us to own. We have more confidence that gold goes back 3,000 or 6,000 years and so on. So that's the cryptocurrency answer. In terms of blockchain, the actual underlying technology, we do think that blockchain has been a terrific technology. It allows for processing of mass amounts of data in terms of payments and transactions with more accuracy than previous systems. But it's still, to us, it's still like, do we even need it? Like, it's just a question. Do we need? I don't feel like I ever have a problem using my credit card to buy anything, for example. I don't know that blockchain technology for batched transactions is advancing things, but Marc may have a different perspective.
Yeah, just on the crypto, I agree with John's comments. I mean, I think we acutely understand investors' desire for an alternative to the dollar. There's a cohort of investors that prefer gold, given its long history, and it's been used. It's probably the purest form of a storehold of value for our currency. But other people feel like, crypto is the better path to hold an alternative to the dollar. So we can understand that, but it's more volatile and it's got a shorter history. So for those reasons, we push in the other direction. As it relates to blockchain, yeah, there's some friction in terms of processing transactions. If you're going through, the current established protocols, those are higher fees. So there's a desire to find some alternatives to make transaction processing a lot cheaper. Blockchain could probably facilitate that, but we'll see where that goes. I mean, I think the big banks have been looking into blockchain, use it in some limited areas, but that's about all I'll say on blockchain. I don't know that I am closer to it as John describes. We're probably shoulder to shoulder in terms of where we stand on blockchain as a technology.
Yeah, just one more quick thought. Like, so the thing with gold is that there's only so much of it on the planet, and there's only so much that we mined and that we've got available to us to sort of backstop currencies, where cryptocurrencies are literally being minted every single day. So I encourage you, if you're interested, to go Google a recent video from Andrew, or a video of an interview of Andrew Ross Sorkin, the renowned reporter who also covered the global financial crisis in a book called Too Big to Fail. He's recently come out with a new book, 1929. Sandy Bragar, our chief client officer, recently mentioned that book to me. But if you look at that video when he's being interviewed, during that interview, Larry Fink, the BlackRock CEO, apparently in an interview with Andrew, mentioned something about, yeah, we ought to have a Sorkin coin. And literally that same day, the Sorkin coin was created. And shortly thereafter, it went to $270 million of value. And then it crashed to about $17 million or something like that. But Andrew cites that as a challenge when you're thinking through some of the advances in currency and payment methods and so on. So Bitcoin would be the way we'd probably go if we were to recommend a cryptocurrency, but just something to think about.
Thanks. So just continuing the discussion, given the recent move in gold prices, is there a greater role for real assets in our portfolios going forward?
And that's a great question, Marc. You want to touch on that with infrastructure, real estate, and other things?
We think so. I mean, gold is a diversifier. It diversifies against higher inflation and diversifies for other investors in terms of sanctions and confiscation. Obviously, that's happened to Russia as part of its conflict with Ukraine. Other bad events tends not to move in tandem with financial asset returns. So we think there's a case to be made to have a durable position in gold. We started adding gold into certain strategies, I don't know, John, 6-7 years ago.
2019, yeah.
So it's been, and at that point it was an out of consensus allocation. More people are starting to see the value of gold. So we like that. There are other ways to play hard assets, including infrastructure and real estate. And between those two, we prefer infrastructure. So yes, we have strategies available to lean into hard assets, gold, and infrastructure if there's, interest.
Yeah, I just, so I won't modify what Mark said, but I will mention that where we own gold is really in the umbrella of our dynamic portfolios, which can be a little different than their benchmarks, and specifically within a bucket that we call our diversifiers. So some clients will have some exposure to gold through that exposure in our dynamics, where our strategic portfolios are really designed to be more like their passive benchmarks, and they wouldn't naturally hold much in terms of real assets and nothing in terms of gold or other kinds of specific commodities. So you can reach out to your CST if it's of interest, and they'll help you think through the portfolio implications and holdings.
There's also been recent headlines about regional banks, specifically about bad loans at regional banks. Do you see any effect on private credit managers, or what are your thoughts on that?
So we always have to debate about what topics we're going to cover on the webinars, because there's so many from one quarter to the next. But regional banks, you're right, they've been in the headlines. It's a great question. We were looking at our updated research, as you remember, from the Silicon Valley Bank collapse at the beginning of 2023. We wrote some pieces around that period of time. We talked about it with our clients. We sent some letters out to our clients about the impact. At the moment, we don't see that billowing forward. There will no doubt be some trouble for some lenders at regional banks and other forms of private credit. And I'll have Mark talk a little bit about how we approach private credit, which is decidedly different than a broad-based approach. But for the regional banks, as we look at their available for sale securities and their held to maturity securities, those were really quite impaired at the beginning of 2023. That was my hand showing that the bar went really down on our on the charts that we follow. So we were really concerned at that period of time. Since then, the AFS securities and the held to maturity securities have sort of run off. They're less impaired today than they were a couple of years ago. It doesn't mean that there's still not trouble within that overall bucket, and they still are held at greater losses than any time prior to the beginning of 2023. So there is still some area of concern there. There most certainly will be some problems for some regional banks. How severe those get has yet to be determined, but we're monitoring it quite closely, and it almost made its way into the conversation today, but we decided to push it until a future webinar.
Yeah, I'll just add, like, the private credit industry has just grown exponentially over the last 15 years. Today, it's over $1 trillion. The good thing is risks in the system are spread across more lenders because of the emergence of that asset class, whereas in 2008, a lot of the risks were concentrated in the big money center banks. Today, it's much more dispersed across a much larger number of lenders, which is a good thing. The second thing, there's much less leverage in the system, whether it's with the banks. Some banks were leveraged at 30 times in 2008. Now, let's say around 10 times. The private credit funds tend to be levered at 1.5 to 2 times. So much less leverage in the system. The other thing is you're generally getting paid for taking on more risks. So spreads in private credit are wide. For the most risky borrowers, you're getting a pretty healthy spread to overnight borrowing rates. For the areas that we play in, lower middle market, spreads are 550 up to 700. So even if you do have some defaults, largely you can absorb that with these higher spreads. And we also tend to favor that part of the market because you do get covenants, you do have more rigorous underwriting. And the managers that we're involved with have demonstrated and have very capable restructuring teams and have the ability to kind of take over a borrower should something go south and they need to operate the business and kind of get the capital back to investors. So yes, we'll go through a default cycle. There'll be headline news. People go bankrupt. That's just a normal course. Anything credit related is not backed by the government. So you will go through periods where you're going to have some stress. It's just you got to kind of pick areas of the market where you think you can best absorb that impact, and where we position ourselves, we think we are.
Yeah, and again, just for clients, just reach out to your client service team if you've got specific questions on exposure that you may have to private credit in your portfolios.
Could you discuss importance of Federal Reserve's independence and what are the potential risks to the monetary policy if external pressures lead a new Federal Reserve chair to change interest rates too soon or at the wrong time?
Well, I think it's pretty clear the next Fed chair is going to be much more aligned with President Trump in regard to his thoughts on interest rate. That's going to be part of the interview process, and someone that doesn't share his view for lower rates, it's hard to see that person being nominated. So my expectation is whoever that person is going to, aggressively pursue lower interest rates. Right now, the market's forecasting one cut, 25 basis cuts in December, another 100 basis cuts over the course of 2026. My expectation would be that whoever gets nominated kind of pulls forward those cuts, so they come sooner rather than kind of dispersed throughout 2026. What happens after rates get down to 3%, because inflation is kind of bottoming out around 3%, as we discussed. So having negative cash rates from a real standpoint seems a bit aggressive in this economy, but I think that's the real question with the next Fed chair and the next composition of the Fed, given what President Trump has stated for lower rates. I think there's a view that we should get down to 3. That's more the natural rate. What happens after that, I think, is the big question.
Yeah, I mean, the executive branch and at different points in time has long influenced policy setting, monetary policy setting. Just it's probably feels unprecedented, and it might be unprecedented because of all the headlines and the overt just sort of bashing of the Fed chair and others with Fed policy. That is very different than years past. Marc touched on earlier that the chart that showed the 3 lead candidates for the new Fed chair, Michelle Bowman, is also a candidate, and Rick Riedler of BlackRock, a fixed income CIO at BlackRock, is also a candidate. As Marc mentioned, we don't expect anybody that's not a dove, that's not in favor of reducing short-term interest rates. And as I mentioned with the Fed balance sheet, if there's any sign of turmoil in the economy or the markets, to then potentially take on even more securities onto the Fed's balance sheet to reduce the long end or influence the long end of the interest or the yield curve going down. So, yeah, the influence has been what it is. We'd like to see an environment where people don't get bashed for simply doing their jobs or get terminated for simply doing their jobs. But I think that's the reality that we're in for a while.
Marc, you touched on the higher use of energy with AI. Are you seeing areas of opportunity across the energy sector?
There are parts of infrastructure and we touched on this before. I think the derivative play on AI has been power and utilities, electric utilities. So we have some positioning there, but nothing's cheap. Certainly in the U.S., nothing is cheap. You probably could have made the argument 6 months ago. There were parts of biotech that were quite cheap, given just the overhang from RFK and a bunch of policy changes there. That market has snapped back quite nicely in the last 6 months. But power and utilities is probably one way for investors to play AI if they don't want to, pay up for the tech giants and pay, 50 times earnings for NVIDIA and some of the higher multiples for the tech leaders.
All right. As we're getting close to the end of our webinar, I will ask probably the last question. Could you please expand on how all the information you shared today relates to longer term, 5-7 years out investment decisions?
Oh man, that's a doozy of a question for the last one. So as we were mentioning, they're just we started the conversation with, there's these massive global forces that are at play. So, for example, if we knew that the U.S. was going to, establish adequate and ample and cheap supply of rare earths and other minerals and energy, that some of the topics that we touched on, as well as labor, or gaining efficiencies from labor associated with AI, that would be a clearer picture to us. But as we talked about, even AI, the massive investment that's being required there from a CapEx perspective in these immense data centers that are required to do these incredible computational calculations to get the information and report on it quickly, the energy demands associated with that. We just have some real concerns. It is very clear to us that the US and China are leading the world in terms of the negotiation, and their allies will fall in place and their trade relationships will fall in place. We do think ultimately things will be resolved without some kind of major world conflict. We hope that that will be the case. We hope that China doesn't invade Taiwan. But Laura, there's so many unknowns. It's a great question. We'd love to answer it with clients directly when we meet with them. It's just a little hard in the amount of time that we have here. But it's one of the reasons that we're really emphasizing diversification across economies, across the capital structure, across different kinds of assets that one can own, and just trying to remain steady while we continue to monitor these developments on our clients' behalf. Marc, do you want to add to that? Let me just say one thing. I guess over the next 5 to 7, 10 years, we certainly expect portfolios to go up over that period of time. There may be some volatility as things are, working themselves through with these different avenues of negotiation and the global forces that we mentioned. But clients should feel confident that over 5, 7, 10-year periods of time, that their portfolios will go up in value, and we will continue to monitor the risks and the opportunities as they develop in the opportunity set that we have for you.
Okay, we saved the most important question for the end. Who is going to win, the Dodgers or the Blue Jays? This is probably a little biased for this group, but.
Well, Aspiriant's headquarters are based really in Los Angeles and San Francisco. And, as we look at that, it's hard not to be a Dodger fan. There are many of us in this office that root for other sports teams, but it'd be great to have a repeat for the Dodgers. From my humble perspective, there's probably some Canadians on the call that feel differently.
Marc, did you want to weigh in?
I mean, I'm a Yankees fan, so we can't seem to get our act together. The Dodgers are the new Yankees, so it's hard to watch. But yeah, they should win. But I mean, Ohtani is a unicorn, so it's just what he does on the mound and hitting is just super impressive. So they're definitely the favorite.
All right. Thank you, Marc, John, Dan. Looks like we've covered most of the questions we received today. We appreciate your participation and thank you for sharing your questions with us. If we didn't get to your question, no worries. Your Aspiriant team will be following up with you shortly. To wrap things up, while we remain optimistic about the opportunities ahead, we recognize that ongoing policy uncertainty and market volatility can feel uneasy. We hope today's conversation has strengthened your confidence in the research we conduct and insights we gain as we manage your portfolios in balanced and disciplined manner. We truly appreciate your trust, partnership as we navigate an ever-changing global economic and political landscape together. Please remember, your client service team is always here to discuss your thoughts about the markets or your portfolio, so please don't hesitate to reach out at any time. Thanks again for joining us today. We look forward to welcoming you to our upcoming webinars. Take care and have a great day.
Thanks, everybody. See you soon.